Oh, there we go. We are live. Welcome to this Daily Maverick webinar on, it's a book review, but it's going to be a wider discussion on the retirement industry as well. The book under discussion is Secure Your Retirement, How to Beat the Effects of Corruption, Ratings Downgrades, and a Global Pandemic. Welcome to all our viewers and to my esteemed guests. They don't need any introductions, but I'll do so anyway. We've got Bruce Cameron. He's an award-winning journalist. He's been a pension fund pioneer for many years when he was the editor for the personal finance sections at independent newspapers, but he's now an independent or a freelance writer, and he also contributes to Business Maverick, where I am an associate editor. The other guest on the line is Wouter Fourie. He's a certified financial planner and also award-winning planner as well from the Financial Planning Institute. Welcome, gentlemen.
Hi, Ruan.
Thank you, Ruan. Hi.
So this book that was released recently called Secure Your Retirement is not your first collaboration. You did a book called, what was it called? The Ultimate Guide to Retirement 2 to 3 years ago, which was very successful and stated very fundamental facts and important matters around retirement savings and the regulations as well. How is this book different from the previous? Bruce?
Well, it was written by accident, in fact. What happened was that when the shutdown was declared, I had phone calls from people at independent newspapers, people who are on the retirement fund, and I used to be a trustee of that retirement fund, and they were asking me for advice when salaries were cut and things like that. And I realized there was a major problem. I mean, even the pension fund aid for pensioners, subsidy issued by the company was cut by 40%, which was totally illegal. They never consulted. It was a contract and it should have been stood by. And then I thought about it and thought, no, something's really wrong here. We need to start writing about it. And I contacted Tim and spoke to him about it. And he agreed, yes. When I started, I was going to write 3 columns. I thought that would be about it. There ended up being 21 columns in the end. But that was the basis of the book. So it was never planned. And then after the first couple of columns, the publishers contacted me and said, could they publish it as a book? And I said, yeah, sure. So it suddenly became a book overnight. And it was quite a problem because the books normally take a while. But this book was being written as I was writing columns and checking with Wouter, getting Wouter to get stuff done that I could use as well. So it was quite a rush right through.
Wouter, to secure retirement is quite a hot topic at the moment. You know, the challenges facing pensioners around COVID, people losing their jobs, our country being downgraded to junk status, and just all kinds of other issues around people's pensions that are hitting the news headlines. Why should we have this discussion today, and why is it so important?
I think, first of all, the discussion should not be just limited to today. I think this is an ongoing discussion that we need to have. And I think there's a major lack in terms of educating people in terms of retirement. I think what's made this more relevant at the moment is the fact that we're in a crisis. And I think there's a lot of communication about the performance of investments, investment funds, and etc. And also being in a situation where we were in lockdown for 2-3 months, there was a lot of information available on social media, and I think that was the reason for people being more attentive about the reality of pension planning. And also, I think the dire situation that we're sitting in our country in terms of economic growth, in terms of unemployment, in terms of people being retrenched and then needing to make decisions for the first time in their life in terms of their pension funds and provident funds. And I think that's the reason for this book to be successful now, and the reason why people should try and get hold of it. And also the previous book that Bruce and myself did, The Ultimate Guide to Retirement, which I think is a more technical book, more comprehensive than this one. And Bruce, I think you described this book more as a lifestyle book than a business book or a personal finance book.
Yeah, I would say so. It's more of a lifestyle book because it's what people have to start modeling themselves on.
So let's just go to the scary stats. The last stat I heard, almost just 6% of South Africans will secure comfortably, which would never be a great stat to begin with. I assume that stat is deteriorating as we speak. So the point is, who are we speaking to today? Who are we kind of telling, guys, having a comfortable retirement is more than just contributing to a monthly pension. You actually have to know what's going on and plan accordingly.
Yeah. Well, my view is that the planning, there's more planning in retirement than there is before retirement. On the day of retirement, you become rich for the first time with defined contribution funds. It's probably one of your biggest investments apart from your house. And you then have to decide how to invest that money, bang on the turn. And if you haven't had any advice up till then. And people make a lot of wrong decisions there for the wrong reasons. And one of the things we've gone into in quite a lot of depth in the new book is that you have to consider the annuity you're going to receive, the pension you're going to receive very, very carefully. And we've come down quite strongly on what's called a hybrid annuity, which is a combination of a living annuity and a guaranteed annuity. The living annuity, you take the risk. The guaranteed annuity, the life office takes the risk. And you need to combine those two sensibly. And as you get older, the pension you get from a guaranteed annuity gets bigger and bigger, and the reason for it is you're more likely to die. So what you get at 55 as to what you get at 75 is an enormous difference in the pension you're going to get. And I think the other thing is people worry too much about what they're going to bequeath to their heirs. In most cases, particularly those who aren't on the 6%, they're going to bequeath nothing. In fact, they're going to be short of money. They're going to be looking to their children to give them money while they're still alive.
So basically, we're speaking to people who are either going on retirement or about to go on to pension and making the right decisions with those lump sum or the savings that they have accumulated over the years. Am I saying that correctly?
Yeah, accepting that what we're doing is taking that lump sum and saying, okay, this is what it is now. But now you have all these other things impacting on it and how you overcome it. Now, I'm a pensioner. I've been a pensioner for 7 years. I haven't actually been affected by it. And it's the way I structured my pension. My pension's actually improved. The value of my pension has gone up by over a third in value. Plus, I've had the pension over the years. But the reason for it is multiple. I invested a lot overseas. My drawdown rate is below 4%. I don't take high-risk investments. I go for boring investments like tracker funds and things like that. So there are ways around it, and people have to learn those ways around it. A lot of people made choices, for instance, for living annuities because they thought they could draw down 7.5% up to 12%, and people still draw down far too much money, and it means they're going to run out of money. Simple as that.
So basically, we're talking about a thing that you mentioned in your book, the point of ruin, the point where you will run out of money before you die. Or before your spouse will need to survive. So that's the first chapter. So let's just take a step back. Where do we start to make that decision or determine what that point of ruin is? Wouter?
Well, sorry.
That's okay, Bruce. Point of ruin is, in terms of a living annuity, is when you reach the 17.5% max drawdown on your investment. In effect, what happens then is every year from there onwards, your income will reduce on an annual basis. So you won't run out of money completely, but your monthly income will reduce on a monthly basis. It's like providing a slow death pull to somebody, because there's no turning back at that point. When you reach that point, it's all the way down. Your income will reduce on a monthly basis. Now, just imagine yourself, Ruan, that this year you get a salary, and next year the salary decreases by 10%, and the year after that by 10%, and the year after that by 10%. And that's reality for people when they reach this point. And especially if you look at elderly people in retirement, I mean, about 60% of your income will be used to cover expenses like medical aid and etc. And medical expenses don't keep track with inflation. If you look at medical inflation, it's usually double figures than the published inflation rate. So it's a really tough situation. And I want to add on to what Bruce said earlier on in discussion, that you've got to get family members involved in discussion about pension planning. So it's not something that sits in a silo. You need to get your spouse involved. You need to get your kids involved. And it's a very important decision. A good friend of mine said something that's very true. And he said that life is not a dress rehearsal. The decisions you make in retirement, the day that you go into retirement, in terms of the product that you choose, can be detrimental in terms of your future if you make the wrong choice. As Bruce also explained, we are very excited about the hybrid options, and it's something that wasn't available a few years ago, and it's something that's more relevant and available to financial planners to utilize in financial planning for retirees.
What are hybrid options? We kind of hear all these technical terms and these new products coming to the fore, and so our financial planners punting certain solutions, but it's quite a lot to take in.
Bruce, maybe you can take this one, yeah?
Yeah, I think, the basis of it is to look at how you're going to survive. And there are two ways to survive. In how much you spend from your pension. You got to look at your needs and your wants. So the first thing you've got to do is finance those needs. And the needs are things like your rent, your food, your insurance, things like that. Going to the movies, going overseas, those are all wants. You can do without them. To drive a cheaper car. In fact, you don't even have to drive a car. You catch Uber, it's far cheaper. So you put all those things together, and then you have your needs, wants, and that's the thing that you have to cover for the rest of your life. The one section you put separately. Now, this is just in broad terms. There are lots of ways of approaching these, but basically, you must cover your needs with a guaranteed annuity. Your wants you cover with a living annuity. But they can be done in different stages. You can start off with a living annuity right at the beginning, particularly if you retire, say, at age 60. And then over the years, you gradually switch your assets to a guaranteed annuity. And the thing is that the older you get, a guaranteed annuity gets more valuable. And the reason for that is you expect it to die sooner. So the return you get on your money is going to be far higher than any return you'll get from a living annuity, in fact. So you've got to play around with it. And good financial advisors will know how to plan it for you and your circumstances. I think that one of the other problems is that people all think they can fit into the same pattern. They can't. They've got different needs and they've got different amounts saved. Those are the two important things. And then you've got the things that Wouter mentioned. Increased inflation, mainly because of health cover. So everything has got to be taken into account by a financial planner. You don't just sit there and say, oh, I need the X amount. It's rubbish. You need to look at things, look at the inflation rate, what the pensions inflation rate, what your personal inflation rate is likely to be. There's a lot that needs to be taken into consideration. When you're saving, it's different because you're putting money there. And you asked a question earlier, Ruan, where does the first mistake get made on getting a pension that's survival? It's made on the first day you go to work, and you don't save enough then, you've got a problem. And the biggest single problem in retirement savings is people resign along the way, take the money as cash, and go and spend it on wants, not even needs. They go and spend it on wants.
I just want to interrupt you for a second there. You refer to taking all these different elements into considerations. When you are already onto retirement and living off a pension plan, is this something you have to revisit every year, or a kind of a regular kind of period that you would advise to do so?
No, I think you've got to revisit it every year.
Yeah.
And I mean,
Yes.
Bruce is the guy to answer it because he gives the advice and he knows how often it has to be done.
So in your book, you mentioned two specific scenarios where people have failed to cater for themselves or their loved ones properly. The one is women, usually a spouse or a daughter or a dependent, and the other one is people with illnesses like dementia or Alzheimer's, which is kind of changes the whole kind of debate a little bit. Maybe you can elaborate on that.
No, I think both of them are very important situations. And as I mentioned, that's why it's important that you don't do retirement planning in isolation. If you look at spouses, in practice, what we see often is that the wife relies on the husband to make all the plans. And at the end of the day, she sits with all the plans and she's got no idea what the plan looks like. And also the impact that something like a divorce has on retirement planning, especially later in life, where you can half your retirement funding when you sit in a divorce situation. If you look at dementia, as Bruce explained, that the challenge that we got in South Africa is that the letter of attorney, the power of attorney, is not relevant when you have dementia, and you need to involve family members with you in terms of your planning in the process. So the advice to all our clients usually is that you need to have the couple involved in the financial planning. So even in retirement planning, husband and wife should attend the retirement planning meeting with their financial planner so that they both understand what they have, what their needs are, and what their wants are. And the revisiting of the financial plan is so important because life happens. I mean, if you look at last year this time and you compare it to this year, it's two different worlds we're operating in. And as the world changes, your lifestyle will change as you get older, and you need to adapt your financial planning and your retirement planning around it. And just to add on to what Bruce said in terms of the hybrid products, it's also important when you do the reviews, you will clearly be able to identify when the hybrid option becomes relevant to you. At the moment, we see there's more attraction towards guaranteed annuities because the rates offered by the companies are much more attractive than a few years ago. And that's mostly due to the bond rates, which have increased, and the companies often use the bonds to secure the guarantees that they pay out to pensioners. So again, on all three subjects, you need to review the plan on a regular basis, at least on an annual basis. Secondly, in terms of planning for women, it's important that they be part of the pension planning. They need to make sure that they're involved in those meetings. And thirdly, as well, dementia. As parents, we need to be active. We need to be part of the pension planning. We need to get involved in family meetings where we sit with our older fathers and mothers and have the discussion about pension, because their problem becomes the children's problem if they're not involved in from the beginning.
We have a couple of questions for you. Ruth Coggan asks, is it possible to change a living annuity to a guaranteed one? And then a second question from Felicity Steerman, what do you do when you realized on day that you have to retire that you have not enough, you don't have enough to retire on? Is it the end of the world, or do you actually have the options?
Do you want to handle the vote, or should...
I'll take the first one. You take the second one, Bruce. I think very important. At any stage, you can change a living annuity into a life annuity, into a guaranteed annuity, but not the other way around. Once you've bought the guarantee, the company that issues the guarantee on that income then becomes the owner of the capital, and you become the owner of the contracted income stream that's negotiated with that company. So yes, to answer the question, you can move from a living annuity into a life annuity, but not the other way around.
Just repeat the question again, please, Ruan.
Felicity Steemar wanted to know if she is about to retire and she realized that she does not actually have enough to do so. Is it the end of the world, or are there actually options for her to change her fate?
Well, it depends on the person. I mean, I've continued to work. I had to retire, but I continued to work. I work mainly as a retirement fund consultant and as a trustee. Other people have other options. I mean, I became a trustee as a result of what happened, because I'd been a trustee before, and people wanted my expertise, which was useful. But other people have other things, they could have hobbies. They could also rely on children. There are lots of different avenues that are open to people, but you've got to think constructively about it. I mean, one thing that I don't think people should do is go and take their retirement money and go and buy a business with it, because then you're putting everything at risk. You've got to build on what you have, not reduce what you have. And there are books about, there's even a website in South Africa, which we've got mentioned in the book, where you can go and you can actually either sell your services or volunteer your services. I think people who are well off should volunteer their services too, because it keeps you young. No one would say I'm 110. So yeah, we can't hear you. We can't hear you.
Hear me now?
Yeah, now
Yes.
we can hear you. Yeah.
Another question, which is quite interesting, by Hamid Rahim. Says you mentioned all these options of products, hybrid products, different types of annuities, but do these products cater for Sharia type of investment needs, or do you think the industry actually needs to kind of be better at and to kind of cater for more specific requirements around religion or some stuff like that?
So there are numerous funds available for Sharia, and I think the industry is old enough to have seen the needs, the different needs that's required by pensioners at the moment. So there's a lot of options available, and we're also in a lucky position in South Africa that we don't just have one specific product provider or one specific company. So as pensioners and as individuals, we've got a freedom of choice in the country, which is also good. And also recommend that if you do retirement planning, don't just stick to one specific company or one specific product. Do your homework. I think the internet allows us to do a lot of research, and also seek wise counsel. Go and see a financial planner, but not just one, maybe speak to one or two or three and look at different options. What's important is there's different financial planners who specifically focus on different areas of retirement planning. And there are people who are specialists in Sharia retirement planning, and then some specialize in, for example, in entrepreneurs to help them with retirement planning, etc. So you've got to find the right mix in terms of a financial planner who can assist you with the specific area or needs that you have.
Can I just add one thing to it? The problem is not so much on the living annuity side. The problem is on the guaranteed annuities. There are not many Sharia products. I don't know if they are. In fact, Wouter, what's your view? I don't think so. And that should be, something should be done there.
I agree with you, Bruce.
So let's just get back to basics. I am a person, I'm turning 60 years old, I am about to retire, and I'm in an environment where capital growth is flat in a country and with my investments. What do I do now? Do I just kind of keep my capital safe, but not really focus on my income stream in future? Or do I do a little bit of both? How do you handle a retirement in such uncertain times that we find ourselves in today?
I think the first thing to do is not to panic. That's the worst thing to do, to try and panic and to make hasty decisions in terms of what you should do and what you shouldn't do. When you're in retirement, you've got to protect your capital. You've got to have capital growth in your portfolio, but you also need to make sure that your income is good enough to cover your monthly expenditure. And again, that's why it's important to look at this on an annual basis. You need to have a written budget. You need to make sure that you stick to your budget. And you also need to make sure that you've got an emergency fund, that you don't need to go into credit or use expensive credit to finance lifestyle expenditure. The important thing on capital preservation and capital growth is a magic word called diversification. So the old saying that you can't have all your eggs in one basket is relevant. If you have a pension fund, you've got to have a diversified portfolio that protects you and also gives you opportunity in times when markets are down. And believe it or not, there are lots of opportunities when markets are down to actually increase the growth in your portfolios. And that's where a good portfolio manager and financial planner plays a very important role in your planning.
Can I just answer a question that's there by Wouter Ruan, saying that you should invest in money market or pay expensive costs? That probably is one of the most dangerous statements I've read in a long time. And first of all, money market is not necessarily safe. It depends what those money market funds invest underneath.
Yes.
And they can be very high risk investments. You need to check those out. Most of the people are quite cautious about what they say about it. And the other thing is that if you, in most cases with money market funds, you're getting very close to the inflation rate. You've got to have growth on your funds. You've got to invest it in other things, which give you more growth. And equity markets provide the most growth. It's as simple as that.
So Wouter said the first thing we shouldn't do is panic. Well, we are in a state of panic at the moment. If you just look kind of the talks about prescribed assets, changes to Regulation 28, equity markets being flat, corruptions around the country. What is the alternative to panic? Do we kind of just stick around and see what happens, or do we have any say, or should we have any say about what's happening in our, whether it's state-owned pension funds or private-owned pension funds?
Well, luckily we live in a country where we've got the ability to vote. So I think that's the first thing that you need to do is people need to vote to make sure that we've got the right leaders in place to assist us to get this economy to grow. But that's another political debate, and we're not going to stick with that. So to answer the other question, should we panic or should we not panic? I don't think you should panic. The reason why I say that is if you panic, you make irrational decisions. So I think the correct thing to do is you need to look at the big picture. You need to look at your own situation, what you have, what your abilities are, what's the dangers in terms of your own lifestyle planning, and you've got to seek good advice. A lot of people try and play Dr. Google and via Google search try and manage their own pension funds, and I think it's a dangerous thing to do. I don't prescribe myself medication. If I'm sick, I go to a doctor and I seek professional advice to assist me. And I think that's the biggest mistake people do is they try and solve the problem themselves. There's fantastic financial planners out there who can assist you, can sit with you and take you through the different aspects. And I want to touch on what Bruce just said about the money markets and etc. So viewers must remember there are different asset classes that provides different income and also different investment periods. So if you have to invest money for a short term, then a money market should be the place to use. But if you need money for the next 20 years, you've got to have exposure to growth assets, which is equities, property, and bonds in the portfolio. So you've got to have that mix in the portfolio. And not just local, you've got to have offshore exposure in your portfolio as well. And the benefit of offshore is you open up 99% of the world markets that provides other opportunities for growth. So it's not just that you've stuck in one specific country, you've got options to go abroad to make sure that you lessen the risk in your portfolios. Can't hear you.
One of the questions that was sent out before the webinar is how do you know what financial advice to trust or what financial planner is legitimate? There's been so many stories during this crisis of people being done in or taken for a ride because they were panicking or it is a time of crisis. How do you make sure as the pensioner or the person contributing to these products that you are actually getting the right advice from a certified advisor?
Can I answer that? Because
yes.
I just think that from me, it's coming from a neutral position. You definitely need it. And there's very easy ways of actually assessing people. The first thing is go on to the the website for the what's it called, Wouter?
The FPI.
The FPI website.
That's the Planning Institute.
Yeah. And now the thing is about this, there are a couple of things about that. One is that they properly qualified, and they've got to write exams and things, and they've got to abide by a code of conduct. Okay, I'm not saying that everyone will stick to that code of conduct, but most people, the vast majority, will stick to it. And they're far better qualified than people get their qualifications from the Financial Services Board. But at least there's a standard there as well, and they've got to be qualified in different things. So even if you get somebody who's just registered with the Financial Services Board and is not a CFP, you must check that they're actually sending things they're allowed to check. You can go onto the website, you ask them what they're qualified to check, and you make sure that they are actually qualified for that. But still, a CFP is even better. There's a new organization which specializes in advising people who are giving advice on retirement. They also mentioned in the book as well. So you'll get people who are both CFPs and members of that organization, which gives you far better advice. The big problem with advice, though, is that a lot of people can't afford it. It costs money, but they've got very little saved. And there, what helps out now is the reforms that have come with retirement fund counselling, where people have to be given counselling. They can't be told exactly what to do, but that counselling is going to make a huge difference to people. When they go in and someone says you've got 5 or 6 different annuities that are there from the fund, and you've got outside ones, and you start to understand what's going on. I think a lot of people reach retirement and really don't know what retirement means at all. And that's where guidance helps from a retirement fund. There have been tremendous changes in the legislation affecting retirement, most of which has been very, very good.
Bruce, you mentioned an organization specifically to retirement funds. What is that organization called?
Wouter's a member of it, so he should explain it.
Yes.
Let me quickly explain. There's 2 organizations that Bruce is referring to. So the one is the professional body, which is the Financial Planning Institute of South Africa, or the FPI, and also their website, fpi.co.za. And the FPI is also recognized by SACWA as a professional body. And the members of the FPI need to adhere to specific codes in terms of their education, their training, and qualifications as well. So interesting, in this week, there was an article published on one of the other websites. And if you give me a second, I'll quickly read it to you, the different requirements and the questions you need to ask when you work with a financial planner. So the first one is, what are your qualifications? And as Bruce just said, there are specific qualifications for financial planners. Then, are you a CFP professional? Now, CFP professional is, the abbreviation is for Certified Financial Planner. You can only be a CFP professional if you sat a postgraduate qualification and you've written a tough board exam. In South Africa, I think we've got about 5,000 CFP professionals. So don't expect them to come looking for you. You'll have to go and look for them. Then also, are you a member in good standing with SACWA, recognized professional body? In other words, if you're a member of the FPI, are you in good standing? Then how can I verify your professional status? How many years experience do you have giving advice? I think this is a very important question. Can you explain the service that you offer? Important services. Some people specialize in retirement planning, some specialize in life insurance, some specialize in estate planning. So make sure you speak to the right person. How are you remunerated for your services? Are you licensed with the Financial Sector Conduct Authority? What service do you offer with regards to the implementation of solutions and financial products? And then also important, after inflation, what is the ongoing service that you provide? And that is from the Financial Planning Institute. The other organization Bruce referred to is called the South African Independent Financial Advisor Association. And the SAFA has developed a post-retirement qualification. So the financial planners can actually do a very specific post-retirement qualification, which enables them to address stuff like the income stream rebalances, how to look at dementia, more holistic approach to financial planning in terms of after retirement. And they've also got a website, safer, saiffa.co.za, for more information.
We had a couple of questions about different products, individual products that retirees or people who are saving for their retirement are looking into. Some are exchange-traded funds, other are retail bonds, things like that are actually kind of look worth their while. Bruce, do you think investors or people saving for their retirement should actually be looking into these kind of individual products rather than wrappers, as we've been discussing this afternoon?
You know, when it comes to products, a lot of people buy things think they're going to be worth. The main thing with investing is diversity. You must invest in a lot of things and load them in different ways, obviously. But I just think of property syndications and the number of pensioners who went into property syndications. In my view, property syndications were the single biggest rip-off in this country, and people are still paying for it. Yeah. But there were other smaller ones, like investing in tank containers that were being shipped around the world. And there were sort of fancy tax structures and all sorts of things, and they all got burnt. Mm. And this is what, sorry.
The latest is cryptocurrencies.
Yeah, well, cryptocurrencies are not an investment. They might as well go to the horse races. Nobody knows what alters them. It's like what the gold price is like. Nobody knows who really sets that gold price. 6 little bankers sitting in London, you know. It's opened up a bit, but I mean, it was pathetic. But cryptocurrencies are all over the place, and what causes them to go all over the place? Someone who's speculating very, very seriously in them, I would suggest, and making a huge fortune off all those who are losing, you know. It's a gamble. It's not an investment.
We talked about some changes made to the Pension Fund Act, that one thing that they prescribed was retirement. He kind of just picked on that earlier. I would like you to kind of elaborate on that a little bit and the importance of that regarding, what do they call it? Was it defined benefits or prescribed benefits for pensioners when they retire?
Well, prescribed benefits have been around for a long time. The apartheid government used them, and others have used them around the world. What they're doing is they're saying, we're going to borrow money for you, and we will set the rate at which we're going to borrow the money from you. Now, that could be equal to what the bond market is, but most cases below the amount. The trouble with retirement funds is they get ripped off by everyone. And they get ripped off by employers who stole the bonuses, for instance, and that case is still not settled, with one person in particular fighting it off. But you've had others. I mean, you've even had companies like Checkers trying to rip off their retirement funds, and they got ruled against in court. But you have other people who just scam artists who take advantage of it. You have the government with prescribed investments, and you have others like the commercial outfits where they sell you things like retirement annuities, where they lock you into a contract, and then they give you poor returns or negative returns. And they say, well, you can't cancel because we're going to remove those penalties from you, and you're going to have to pay. In other words, the insurance company is in a no-risk situation. It's like going to Pick and Pay and say to Pick and Pay, okay, I want to buy baked beans for the rest of my life. You sign a contract and you decide you don't like baked beans anymore, but you still got to pay for them. I mean, it's ridiculous, the situation they've got. And you find people, particularly with RA funds, who are investing, they get zilch return because the costs are too high, and they get zapped with these RA penalties. And this, you know, nearly everything we've talked about today goes back to the effect of financial advice, and financial advice from an independent provider. You don't go to a product salesman who works for a life assurance company. You're sure to be had with one of these risky products. You must rather go to somebody who says, okay, use the life assurance product, but this is why I'm saying you must use it. I'm not using it to get the commission. It's a different structure altogether, why you need independence.
Do you think people who are currently contributing to an employer pension fund monthly or an umbrella fund that is prescribed by the employer should get financial advice independently outside of that contribution monthly?
Yes, I do, from one point of view, because it's how much you contribute. So if you go into, now, if you're a low income employer, there are lots of funds available, which are basically life assurance policies with a bit of savings attached. So now take people like in the security industry, where they have to be a member of a fund. Most of the cover is for if they drop down dead or injured or something at which they're at very high risk. Very little goes to retirement funding. So if you have a fund with low contribution rates, there's a gap. It's like British Railways, mind the gap, because there's a big gap between what you're saving and what you'll eventually achieve. A lot of the lower income funds only have a replacement ratio of about 50%. And if you want to be anywhere near that 60%, you have to be able to replace your pension or replace your final salary with a pension that's equal to at least 75% of your final salary. And the only way you're going to get there is if there's a gap, you need to make it up by saving separately through an RA. And one of the big changes that's come is the amount you can now save through a retirement annuity and RA. You're now allowed to go up to allowed to save 27.5% up to a max of 350,000. Well, somebody who's saving that amount is definitely going to be okay. But you need to take advantage of every avenue you can get to save it enough and make sure, and again, we come back, financial advice is going to show it to you, because the financial advisor will sum everything up and say to you, you're behind or you're in advance, and this is what you should be doing.
One of our viewers, Oresta Niska, asked, does any of this apply to preservation funds? Because it almost seems a discussion.
Sorry, Wouter, do you want to answer that?
No, it's fine, Bruce, go.
Well, I was going to say preservation funds are a good thing because they're preserving your pension until you retire. It's just a generic term of another way you can save for retirement. So if you leave your fund and you transfer it to another fund, you've got a number of choices. Now you can be what's called a paid up member of the fund you were a member of. So if it was a good fund, stick with it. If it's giving you good returns, you can transfer it to a retirement annuity, or you can transfer it to a preservation fund. The only thing with the preservation fund is you can't add new contributions to it. That's it. You invest it and it sits there until the day you decide to retire. If you're a paid up member of a fund, you can switch to something else later on or to a new fund. And if you go from one employer to another and that is a different fund, you can switch at no cost. And also all these things are switching. There's no penalizing tax. If you take the cash when you switch, there's a hefty tax on you. There's no tax-free amount or anything like that. There's hefty tax. You're going to pay a lot more on your average rate than you would otherwise pay. So a preservation fund is a damn good thing.
Of course, you must mention that you do get a kind of a tax holiday the first time you access your pension benefits. Is that not true when you retrench or in that scenario?
If you take it at retirement, not if you exit the fund, you're going to be hammered. But if you take your at retirement, you're going to get your first 500,000 tax free. And then I would suggest that you don't take the further amount, even though it's at 18%. I think the other tax advantages of not paying tax on what you've saved is probably going to pay off in the long run. I don't know what Wouter thinks on that, but that's always been my view. Take the tax-free, leave the rest.
I don't totally agree with that, Bruce. You've got to do the sums, and you've got to look at the specific situation for people. So when we do projections for clients, we take that into account. And if you compare, you must remember when you take the money at retirement, the 500,000 that you take, the income that you draw out of that won't be taxable in the future, except for interest, etc. But the money that you draw out of a living annuity is going to be taxed. And what you're trying to do is you need to try and balance the two in terms of your tax rate. So you can there's a sweet spot where you can actually get a better advantage by taking a bit more of just the normal 500,000 tax free. And again, it's important to look at your specific situation. Also, the preservation funds. What's very important about a preservation fund is the money that's sitting in a preservation fund keeps on growing. So it's not a question of you just put it into a preservation fund and that's there. It keeps on growing. And also the benefit of that, exactly the same as a pension fund and retirement annuity, is the income that's generated within that fund is not taxed while it's growing. So it's really a great tax benefit. And also the word preservation refers to the preservation of the tax benefit. So if you transfer it from a pension fund into this, there's no tax on the transfer of it. I just want to add on to it the importance of taking tax into account when you do retirement planning.
Yes, that was really my next question.
So if you contribute towards retirement, and as Bruce just said, you can contribute up to 27.5% of your taxable income. Now, just to explain that in plain, simple terms, if you take 100 Rand and you take your 100 Rand and you put it in the retirement fund for your old day, the benefit that you get is SARS pays you back your marginal tax rate. So if your tax rate is 30%, it means that it's costing you 70 Rand to get 100 Rand's benefit. And that benefit is yours for life. And then one day when you retire, that amounts, 500,000 of it is tax-free that you take out tax-free. And if you take that into account, there's no other investment that beats a pension plan, a retirement annuity, provident fund, or a pension fund. The contributions and the tax benefit is enormous. The magic, when it comes into play, is when you get the refund from SARS, put that back into your retirement fund, and then you see the magic happening within your retirement planning. So don't just spend the money that you get back from SARS, try and put it back into your pension fund, and then the magic starts to work.
And the other important thing is that...
Wouter, maybe it's important. Bruce, just hold on a sec. Wouter, maybe you could just mention that RAs and pension funds fall outside of your estate for estate tax purposes.
Very important, very important. Yes.
And is that for RAs, pension and provident funds?
Yes, all three of them.
And what does that mean? If you can just give it like a few sentences to explain that.
Okay, so during your life, when you build up a pension fund and the day you retire, you've got 6 or 7 million sitting in your pension fund. If that was taxable in terms of estate duty taxes, it means that you would have paid on the 6 million. The first 3 million is excluded from your estate planning, but the rest of it will be taxed at 20%. But because it's sitting in a pension fund or in a retirement annuity fund, it's not part of your estate. So it does not fall into your estate and you don't pay estate duty taxes on it. So it's a benefit that then transfers to your beneficiaries.
So we've talked about tax, we've talked about inflation, we've talked about capital preservation, we've talked about income stream. Bruce, maybe we just kind of double about costs. People have been going on about costs of financial advice or of asset managers or wherever in the food chains they may occur. How important is that in the financial planning decision?
Very important. There will always be costs, except that there are, but they're comparisons of costs. Like a lot of life assurance industry costs are far too high, particularly with smooth products and things like that. They're working on it because there's a lot more competition. But even if you look at unit trusts, there's some that charge normal asset management fees and then performance fees on top of that. Now that to me is a rip-off, charging performance fees, because if you're paying an asset management fee, as your assets grow, they're getting a bigger and bigger percentage. So why charge a performance costs? Normal asset management fees are performance costs. I invest a lot in tracker funds because they've got the lower costs, far lower costs. And I think it works. I'm a boring investor, by the way. I invest in things like tracker funds. I don't go looking for people who are going to outperform 1 month and then be bottom of the scale the next month. There are good investments, but, in the end, very few consistently outperform tracker funds, and I don't have to make guesses. I'm getting the market average, and it works.
So one more point quickly. You mentioned something about retirement fund counselling, which is a new kind of service that should be provided in terms of the Pension Fund Act, and with new rules that were introduced last year. Maybe we can elaborate a little bit about that and what it means and what value it will bring to pension funds or pension fund members.
Yeah, there are 3 regulations affecting it. The first one affects the initial investments and when you join a fund. So they will tell you about what the investment policy is and what sort of return you can expect and things like that. All information that if you've got a financial advisor, the financial advisor also needs to get access to work out what sort of return you're getting, etc., into the future. Then the next one comes on exiting a fund. This is when you leave your fund for any purpose and then take your money. Now, at one stage, what happened when you retired, all you did, you got given cash and you were taxed on it. When they revised the tax rules on the taxation, they also took this into account, that you need to be counselled so you can have the choice of leaving your money where it is. So you have to be counselled on all these different options and be told in that if you take cash, you're going to be thumped with the tax. And also the dangers of withdrawing and what effect it will have on your final outcome. Then, to me, probably the most important one is at retirement. You have to be told, and by the way, retirement fund counselling is all free. You don't pay, someone else pays for it. You don't pay for it out of your pocket. And it's not financial advice. It's just telling you about it. So if I want to take an annuity, I will be told there's a guaranteed annuity, there's with profit annuity, there's one that goes up with the inflation rate, there are living annuities, and they'll all be explained to you in that. So you actually understand the basis. So then when you go for financial advice, when your financial advisor is talking to you, you'll actually understand what he's talking about. By the way, in retirement, one thing I want to say about financial advisors, the best thing about it is they keep you on track and you need to listen to them. Often the complaint I get from financial advisors, I told the person, if you go for that option, you are going to fail. I guarantee it. And they still go for the option. And I mean, that's sheer stupidity.
So where do people access retirement fund counselling or counsellors?
Whichever fund you're a member of. If you're a member of a private fund, like one provided by your employer, they have to provide it. If you're a member of a retirement annuity, they have to provide it. So it's all there for you. It's all done for you. And you don't go and ask for it. It has to be given to you.
Mm. Okay. And I think I just want to latch on to what Bruce said, is there's a big distinction between financial advisor and a counsellor. The counsellor usually just counsels you on the specific pension fund and the benefits and how it works and the impact on withdrawal, etc. Where a financial advisor takes into account the full spectrum of your situation. Also, financial advisors need to be registered to provide financial advice, and people should not confuse counselling with financial advice. There's a big difference between the two.
So we're in a scenario of great uncertainty regarding COVID, people who lost their jobs, capital markets that are flat. So we're almost done with the webinar. So it's a large piece of advice. Where do we go now? Do we just go to our financial advisor and plan for this current scenario and our eventual financial goals? Or do we have to make some tough decisions right now to at least preserve some of our capital for the future?
I think both. You need to be aware of your situation at the moment. A lot of people try and avoid it. It's like going to the dentist. It's important that you do this. It's an important exercise that you need. And if you know where you are at the moment, you've got a very good idea where you'll end up. Otherwise, it's like walking in the dark. You're going to bump your head and then realize you're in big trouble. And then there's usually not enough time to rectify it. So I think that's one of the big important decisions that needs to be taken now. And I think something else, Ruan, we might just have to touch on Regulation 28 and living annuities as well, because it's something that comes up from a lot of conversations with clients at the moment. They're very concerned about Regulation 28 and prescribed assets. And just to put that in context, so before the age of 55, the pension funds that we invest in is regulated in terms of Regulation 28, which prescribes the assets that we can use within the pension funds. Now, after age 55, you are able to draw and retire from your retirement annuities, etc. And then Regulation 28 is not applicable anymore. Now, the current requirement in terms of Regulation 28 is that you're limited in terms of your offshore exposure in your portfolio. So you're only allowed 30% offshore. But as soon as you go into retirement, you've got the world to choose from. There's no limitations in terms of offshore. So you're going to go 100% into offshore. And that's one of the discussions I think a lot of clients need to have with their financial advisors. Is it the right place? If you're at the age of 55 and older, maybe this is the time to increase your offshore exposure in your portfolios as well. So the exercise is not just limited to people working towards retirement, it's also after retirement. And again, the benefit that you get from seeking wise counsel.
Fantastic. So there's a lot to take in. There's a lot to consider. We haven't even discussed all of it today, but at least we have an idea where to start. And that all starts with proper financial advice and a structured pension plan. Thank you, gentlemen. Your book, Secure Your Retirement, is available at present, and I'm sure that will be a great help to many. I thank you for joining us today and educating many of our viewers and myself included. I want to thank you, my producer, Nicole Williamson, and my backup presenter, Sasha Planting, who will do a write-up on this webinar that will be available on Business Maverick tomorrow, as well as this copy of this webinar on our webpage. I thank you very much. Hopefully, this will be the first of many more discussions around retirement and planning for our future. Till the next time, thank you very much. This is Daily Maverick Podcast, Ruan, Jooste. Thank you. Bye.
Thank you, Ruan. Thanks, Bruce.
Bye.